Hello, everyone. Welcome to a new podcast video. Today, I'm joined here with Larry McDonald. He's a New York Times bestseller of the Lehman Insight story. He's also the founder and author of the Bear Trap Report, and he has been with it since 2010, if I'm not mistaken. So he has a writing very interesting investment letter that is newsletter that is very interesting, and he has been able to distributed to very important clients. He works with family offices, wealth managers, hedge funds, retail clients as well. And well, I want to let Larry do the most talking today in this video because he has a lot of interesting things to share with us. Now he just wrote his new book, How to Listen When Markets Speak. So let me pass the word here to Larry and let him go over what's his outlook, his vision, talk a little about the book, and the most important things at the moment since we're going through a very turbulent moment.
Well, thank you, Paulo. Thank you. Very nice of you. And it's, this is a beautiful facility you have, and what you built here on the family office and on the asset management side, I commend you guys.
Thank you.
Our first book was published in 12 languages. And it's the story of Lehman Brothers, which is that big bank blow up in 2008. And I tell my wife once a month over breakfast, if we sell 1 million books, we'll break even on our Lehman stock. But I was a trader at Lehman Brothers. And over the last 15 years, 16, 17 years now, we've delivered about 120 speeches in 16 countries. And what I learned, when you have a New York Times bestseller, you actually make about 10 times more on the speaking tour than you do writing the book. Mm-hmm. But the best part is the people that you meet and the intelligence gathering, right? Mm-hmm. So we do these family office dinners in Geneva, Zurich, New York over the last year, Montreal, Panama City, Miami. And when you host institutional investors in like maybe 10 cities over a 6-month period, especially when there's an election in the United States, you really get a grasp of what people, what the narrative is and most importantly, where the narrative is. Mm-hmm. Because if you know where the narrative is, then you know how much it's priced into the trade. And what was fascinating is in the United States in, say, September, October, November, as Trump won, everyone you spoke to, every single person you spoke to, was like, this is animal spirits, growth. Trump doesn't want the market to go down. Mm-hmm. And now that narrative is slowly shifted. And you and I were in Vail. I was recently in Vail, and I spoke at an event in Vail, and I started to hear this new narrative in late December, early January around the churning out of the debt. So picture in your mind, the United States has 37 trillion of debt, but 16 of it matures in 2024, 25, 26, maybe 17. So, and the Treasury Secretary of the previous administration, Janet Yellen, she issued 2 standard deviations more T-bills than any Treasury Secretary. And all that means for people watching us right now, why that's important is T-bills mature within 1 year. So she didn't want a lot of bond volatility in the election year. T-bills are basically 1 year borrowing from the United States government. Imagine if you issued, say, 4 or 5 billion or trillion of 10-year bonds, those bonds would have been moving violently in the election year. And so by doing that, what she did was she placed kind of this toxic problem out into 2025 and 26. And so the Trump administration now knows that. And so what the market's absorbing now is that in order to term out the debt and issue that paper, those debts, those treasuries over longer dated periods of time, they have to get interest rates lower and slow down the economy, and they want to kill inflation. But most importantly, behind the scenes, they want to term out the debt.
That's the most important thing right now.
Yeah.
The fiscal issue we have in the U.S. And honestly, it was a good, very good point that you brought here is how the debt increased so much in short term and right before a election period. And now that the impact that would have on the upcoming, well, the new administration and how they have to deal with that, plus the tariff that they're trying to implement, that they say it's a way of mitigating the financial risk they have, right? Because with the tariffs, they said they could pay out the debt and
Right.
this decrease a bit the burden, their interest burden they have, which now at the moment, if I'm not mistaken, it's higher already than the defense spending that they use, the annual budget for defense, no?
Yeah, so picture this in your mind. The United States government spends about $7 trillion a year. Tax receipts are $5 trillion, and interest is $1 trillion. So 7, 5, 1. $7 trillion of spending, $5 trillion of tax receipts, and $1 trillion of interest cost. And the problem is what the market and what we talk about in the book is this colossal historic rotation into hard assets. And I'm really proud of the team that we have put it together, a wonderful team. I worked with David Einhorn in this book, Mark Cuban, famous economist, historian Neil Ferguson. And one thing Neil Ferguson told me, he said, wars are incredibly inflationary. And so what happens in markets is everybody's long, every single person in America is 401k, everybody's long a 2010 to 2020 portfolio. But if inflation normalizes at a higher plane with higher bond yields, there's going to be a multi-trillion-dollar migration of capital from financial assets, which are growth stocks and bonds, over toward hard assets,
Real assets,
commodities, things like Bitcoin, gold. And so we have a chapter in the book about gold and the gold miners, and we have a chapter in the book about natural gas. But the bottom line is, if you can remember one thing about this conversation, the fiscal and monetary response to Lehman Brothers' failure was $4 trillion. So think of Lehman, that's the biggest bank failure of all, it's the financial crisis. So imagine the United States government, the Fed and the Treasury, it's like a defibrillator, right? When you have a heart attack. A $4 trillion defibrillator. The fiscal and monetary response to COVID, plus the regional bank crisis of 2023, plus, like you said, the juicing of the fiscal into the election, that came out to 16 trillion. So think of 4 versus 16.
Exactly.
And
Times what the burden they had already in the GFC, which is one of the biggest crises in
Right.
recent years. So.
Yes, exactly. So that kind of spending is triggering that sustained inflation. And right now we're seeing a just historic migration out of big tech and into a lot of other companies that, and global equities as well.
The regional also migration, no? This year at least. I've been seeing Europe has been outperforming US and also some areas in the emerging market region. No? So talking about emerging market, I think that you mentioned there you have a certain view in Brazil, for example. What is your current view there?
So we run on Bloomberg and on Discord, we run a chat. And all that means is picture in your mind a theater. Imagine you and I sitting in a theater with 600 people in the seats. And imagine like 20 people during the week get up on stage and have a conversation. So it's like a live ideas dinner with billionaires and really professional investors, people that run large amounts of money, hedge funds, mutual funds, and pension funds. So we host this conversation every day. And we have a lot of veteran investors that are contributing. Most people in the chat or in the Discord room just observe. They want to learn. But the contributors are there. They're longtime allies of us. And what we've noticed the last 2-3 months is a number of famous investors in there that are very good in emerging markets, are very good value guys that hated Brazil. And now they're going back to Brazil. And the election's a year and a half away. But because of Milei in Argentina and because of Trump, the perception is we have a kind of a realignment in this hemisphere. And because a lot of people missed the Argentina trade, that a lot of people are going to try to
Deja vu.
deja vu. They want to front run the Brazil trade. And then, as you mentioned earlier in a speech here in the office, you have this commodity transition. So if you have the great migration from financial assets to hard assets and commodities, Brazil being in this hemisphere, potentially a better trading partner, as you said, with the United States, they could really, Brazil's GDP could really take off in that commodity regime. What do you think?
Yeah, that's true. That happened already before in 2006, if I'm not mistaken, with the start of the commodity super cycle. And if there is another super cycle, Brazil is one of the countries that should benefit but well, right? There's always issues with the government and other actions they can take, but Brazil being also in a more neutral stance with different regions, it's a way to leverage the connections and also improve the balance of trade,
Yes.
So we'll see what happens there, but it was positive.
Really good news. Our book was just translated into Portuguese.
So that's good for the Brazilian audience, since you have clients in different parts of the world. No, you mentioned that you're in Brazil lately, talking with families.
Yeah. So I'll tell you a funny story. So there's a scene in the book where I'm in Sao Paulo, and I sat down with Andre Estefes.
Yes.
What a brilliant! He's like, to me, he's like potentially the Warren Buffett of Brazil. I know people say Carlos Slim is the Warren Buffett of Latin America, but I was just so impressed. Like, he's so modest. He's such a brilliant man with a visionary. Like, he was talking about United States sustained inflation when we sat down in 2021. I mean, he could see it a long way away. And he's the CEO of BTG Pactual.
No, I know.
And I said, Andre, what does BTG stand for? And he was just kidding around, but he said, better than Goldman.
Yeah, that's right.
But he was, he really gave us a framework for understanding Latin America and how that could help us understand what was coming at American investors. Because Latin American investors have been nearly inflation and high yields for a long time.
Exactly. And if you look at the central bank in Brazil, Roberto Campos, he was also the first central bank after that said we have to increase rates during COVID, because he saw the issue that we would have with inflations in the coming months. So they increased rates significantly, and now it's 14%, right? And yesterday they just increased to 14.25. So we'll see. At least inflation there is much more tamed. It's like 5%, I think, around 5-ish% at the moment. So very interesting, Brazil. And what is also your outlook now for other regions? Let's go back to developed world, right? Of Europe and the tariffs that have been threats. No, I think the main topic now from what we're seeing from clients they're very, I'm not saying afraid, but they're very I'm trying to be a bit conservative on that allocation part, because they don't have visibility of where the tariffs are going to affect the most, who's going to be the winner and loser of the story, and what's the real impact in the underlying businesses now.
So for the last 10 years, people have been conditioned again into American exceptionalism. I should say more like the last 5 years. Because there was a period from 2016 to 20 where it was more global synchronized growth. And Wall Street goes on these tangents, right? So when you're in a weak dollar regime, all that means is a dollar that's in US dollar that's in decline. It typically helps emerging markets, and for a whole bunch of reasons we can get into. But in a strong dollar regime, when the US is spending a lot of money on the fiscal side and driving up interest rates, and when you drive up interest rates, you bring money into dollars because U.S. treasuries are yielding so much. In that kind of regime, then people want to own U.S. assets. What just happened in the last 2 months is potentially a secular regime shift where you're going from what we call American exceptionalism and massive deficit spending in the United States. United States is doing 6 to 7% deficit spending. The rest of the developed world is all like 2 to 3%. So But what people are starting to understand is American exceptionalism was driven by massive deficits. Now we're shifting to austerity of the United States, and at the same time, a fiscal expansion in Europe, a fiscal expansion in China, and to some extent in Japan as well. Yeah. So think about that. This is a historic moment for financial portfolio construction potentially, because if you go from fiscal expansion in the United States and austerity in the rest of the world to fiscal expansion in the rest of the world and austerity in the United States, that creates a weak dollar regime, and that creates a whole bunch of, that's what you were just getting at. So if you look at MS, and so there's some charts which we're going to share, but if you look at the MSCI World or the EWU ETF, which is global value, there's just been hundreds of billions have moved from big tech or growth over to, so on February 20th, or February 19th of this year, the NASDAQ 100 was worth $27 trillion. Mm-hmm. Today, it's about a little bit less than 24. So $3 trillion has either left the NASDAQ 100 or it's lower valuation. And that money's gone into silver, gold, Brazilian equities, European equities, China. And so a lot of the unloved parts of the world that were very cheap, you're seeing that great migration to capital. And we talk about this in the book.
Second. Very interesting moment for gold, no? I think gold has been top performing asset last year. This year is all, again, very strong. 2023 was actually quite good as well. What are your thoughts now on gold? Well, you mentioned, right, that this has moved to commodities and real assets, but then gold is already an all-time high. You think there is still this? A lot of questions that we got that's a very important question we got from the clients. Our thought on gold. We always say gold is very important to maintain in the portfolio. Depends on your risk profile, more or less, but it has to be there in the portfolio, even though it has to be increasing due to its diversification benefits as well. No, and this I don't know if the last 5 years trend, 3 years maybe has been quite strong. So what's your opinion on there?
So the thing people forget about gold is it's a $17 trillion deep, luscious, deep market. I mean, it's so liquid, right? So if you're a central bank and you need to own, one thing that's happening is rates have gone up so much that imagine you're a central bank in Europe or Latin America, and now your coupons on your treasuries are 4 or 5%, and you're getting this juicy coupon. In the old days, you got 1%, and you own a lot of treasuries, like you're up to here. What do you do with the coupons? You buy gold, right? So the higher coupons, higher interest rates are giving more income to emerging market and other developed countries, those central banks. And so they're buying a lot of gold. And the problem is they really can't buy silver and they can't buy platinum and palladium. There's an old saying, all the gold ever mined in the history of the world would fit into an Olympic-sized swimming pool. But all the platinum and palladium and silver in the world ever mined would only go up to your ankles in that pool. You know, that's how big gold is. So it's dominating. And at the beginning of any commodity cycle, the way things, it's like a psychological thing where people have been so burnt by the commodity bear market that for the first migration in, people hide out in what I call the mothership. So they hide out in gold. But as the commodity cycle matures, all of a sudden gold's up at 3,000 now. That's really expensive. It makes silver more attractive. So the gold-silver ratio is about 90 now, which is extremely high for a commodity cycle. In a commodity bull market, which I think we're entering in, that gold-silver ratio should be in the 60s.
Wow.
So what we've been recommending is, take some money out of gold and diversify it into all the other metals, whether it be uranium, uranium, I don't know if it's metal, but uranium for nuclear power. Uranium is really cheap now for a whole bunch of reasons that have to do with the war and the funding of the war. But uranium and silver and platinum and palladium are all coming into multi-year bull markets, and their cheapness to gold is extremely, like, at the most stretched levels we've ever seen.
It's very interesting. Rain is another of those that we got a lot of questions as well, though. Well, I think in the small steps, but clients are getting into more exposed to commodities, real assets, but also look at infrastructure and other things as well that can diversify the portfolio. Still pay a good deal. No, not on the commodity side, but mostly on the infrastructure, real estate. There's some interesting opportunities there as well. But I think it will also be interesting to touch on the report that you create, the newsletter that you always send to your clients, because I think there may be listeners that are interested in also getting to know retail investors that could enter into to the client of yours. No, we really recommend. We have been a client as well lately, and the reports are very enriching, very interesting. They're spot on, like Larry mentioned. He does have this healthy legal insider information because when he talks to people that are actually investors, you get to know the narrative and the sense where the demand is coming from or their opinions to the near future, more tactical. So you can elaborate a bit more what you can expect when you sign up for the...
Well, when I started off in the 90s, and then late 80s, early 90s, as a retail stockbroker. And I felt like I was the last man on the deal team where you get the information after everybody else. And when I went to Lehman Brothers and I worked on the institutional side, what I learned is a lot of their best research goes to the institutional investors first and then makes its way out to the smaller investors. And I thought that was like really awful, And so we created the Bear Traps report. And it's part of the reason why we wrote the book. And we talked about this in the book. We want to democratize information. And so the Bear Traps report is all about, talking with and working with institutional investors, as we do in the book. We sat down with David Tepper in the book, right? Famous hedge fund manager. In the book, we sit down. In the book, it's almost like we do in the letter, where we sit down with institutional investors. And then every week, we share kind of the gems of what we're learning. And so anybody that wants to try us out for a while, it's Tatiana at thebeartrapsreport.com. Tatiana at thebeartrapsreport.com.
Oh, thanks a lot for your time, Larry. I think that was a very interesting conversation. There's many topics that we covered. And if you want to know more about Larry's views on the market, interesting topics that are actionable also, you definitely should check out the Bear Traps report. Subscribe, and any questions you might have, we're more than happy to answer.
Thank you. Thank you very much. Thanks, Pablo.
The opinions expressed on this podcast are their own and do not necessarily reflect the values, ideals, or positions of In On Capital.